Let us see the next question. Following are the rates quoted at Bombay for British pound. Exchange rates are provided to us for rupees per pound. Spot rate is given. We have to understand it is as 72.60 slash 72.70 rupees per pound. 3 months forward points are given. Rate of interest for 3 months information is given for rupee currency and for pound currency. Verify whether there is any scope of covered interest arbitrage, that is a question. So over here the question speaks at, do you have arbitrage opportunity or not, that we are required to verify. Friends, it is very simple question. We are required to say make the computation of arbitrage. However, there is a new point that we have over here, and the new point you must have recognized properly is that buying rates and selling rates are given. If at all the buying rates and selling rates are given, then in that case there are two methods by which you can do answer. Which are two methods? Let us understand. Method number one, in that write down, verifying whether arbitrage is possible or not for borrow rupees, invest in pound. So in method number one, directly we will make the calculation for borrow rupees and invest in pound, and then we'll do reverse. That is the way method number one is there. How method number two is applicable, I just explain that to you slightly later on. So today, borrow rupees seven two seven zero. In bracket I am writing, we may assume any other amount also. Yes, I want you to complete the remaining answer. So today we will enter into the transaction like this. Students are requested to write down answer along with me. Borrow rupees 7270 at the rate of 8% for 3 months. We understand, let's say, we may assume any other amount also. Second, spot transaction, sell of rupees and purchase of pound. What is spot exchange rate? 72.60 slash 72.70 rupees per pound. Sell of rupees and purchase of pound. So higher amount of the rupees is required to be sold. So third, rupees and pound. For 72.70 rupees, you can get 1 pound. You have rupees 7270, you can get this amount of pound. So the final answer is 7270 into 1, that does not make a sense, divided by 72.7. So it is 100 UK pound. Fourth, invest 100 pound at the rate of 5% for 3 months. Fifth, forward contract. The forward contract is conversion of the pound into rupees. These are the transactions which will be entered upon for today. Okay. Now we understand that say after 3 months, whatever the amount of rupees that you had borrowed, for that so there will be repayment of loan. It is principal plus interest. 7270 plus 7270 into rate of interest for rupee currency is 8%, and the time period is 3 months. So 0.08 into 3 divided by 12, that comes to 2%. 7270 into 1.02. Zero 0.08 into 3 divided by 12. 7415.740. So for the borrowing you will have the repayment of loan. Okay. The next is you have made investment in pound. So you will have the maturity amount of the deposit in pound currency. So second, maturity amount of deposit. It will be, that is in pound currency, it will be principal plus interest. So 100 plus 100 into rate of interest is 5% into 3 divided by 12. So 101.25. This is the maturity amount of deposit. That is at the end of the 3 months. Third, conversion of pound into rupees. Spot exchange rate is 72.60 slash 72.70. Forward points are 2070. So it is added to spot exchange rate to compute the forward exchange rate. 72.80 slash 73.40 rupees per pound. This is what we understand is the forward exchange rate. Now conversion of the pound into rupees, you will get less amount of rupees. So you will get this amount of rupees. So rupees and pound. For every 1 pound you will get 72.80 rupees. So how much rupees for 101.25 pound? So 101.25 into 72.8 divided by 1. That comes to rupees 7371. Now at this point of time we'll make the computation of the profit or loss. So calculation of profit or loss. Amount received minus repayment of loan. The amount received by you is 7415.40. Sorry, amount received is 7371 minus the repayment of loan is 7415.40. That is the way we are required to make calculation of answer. So 44.4. So this is the amount of the loss. So for this alternative there is no arbitrage. Let us check the other one. Borrow pound and invest in rupees. Try to do answer on your own. So today one, borrow 100 pound at the rate of 5% for 3 months. In bracket I am writing, we may assume any other amount also. Second, spot transaction, sell pound and purchase rupees. 72.60 slash 72.70 rupees per pound. Sell pound, purchase rupees. So for every 1 pound you will get less amount of rupees. That is 72.60. So we understand that's over here. You will get this amount of rupees for 100 pound. So 72.60 into 100 divided by 1, rupees 7260. So this is the amount that you are going to receive. Third, invest rupees 7260 at the rate of 8% for 3 months. Fourth, importantly, enter in forward contract for sell rupees, purchase pound. And with that say we will make the repayment of loan. After 3 months, 1, whatever the amount that you have borrowed, for that's a repayment of loan. Principal plus interest, 100 plus 100 into 0.05 into 3 divided by 20. So 101.25 pound. Second, maturity amount of deposit. It is investment plus income. 7260 and 8% of that. Into 3 divided by 12. So over here 2 percentage. Zero 0.08 into 3 divided by 12. 7405.2. Third, conversion of rupees into pound, comma, for making repayment of loan. In bracket I am writing in pound currency. Let us see. The forward exchange rate for 3 months has already been found by us. It is 72.80, 73.40. Now we will have conversion of the rupees into pound. So for more amount of rupees you can get a pound. $7405.20. $7405.20 into 1 divide by 73.4. So 100.89 or 8883. Let us take it like this. Last is calculation of the profit or loss. In that amount received minus repayment. Triple 83. Repayment of loan 101.25. So it is negative 0.3617 and this is a loss. So write down answer. Hence there is no arbitrage. This is the way we are required to write the answer. Okay. So now basically what happens, I'd say this is the method number 1. Now going for the method number 2. Let us see, let's say, how to calculate the answer with the method number 2. For that, we'll compute the forward exchange rate using interest rate parity theorem. We know spot plus interest on left hand side currency divided by 1 plus interest on right hand side currency. That is the way we can compute the answer. Of course, system we can see that there are buying rates and selling rates information given to us. So by both the methods will compute it. Everybody is requested to write down answer along with me. I'll give you explanation in the point where I think that say you will have any issue. So 72.60 into 1.02. Why 1.02? Because 8% is the rate of interest for the entire year. So for 3 months it will be 2%. Divided by rate of interest for pound currency is 5%, so it is 1.0125. So over here 0.05 into 3 divided by 12. At the same time, on the other hand, 72.70 into 1.02 once again divided by 1.0125. So the answer on one hand comes to 73.1378 rupees per pound, $73.2385 rupees per pound for the other one. Please write down answer. Now let us have understanding that say how can we draw a conclusion that whether arbitrage exists or not. Let me explain you, do not write anything. Spot exchange rate is 72.60 slash 72.70 rupees per pound. This is the spot exchange rate. We understand that if at all anybody is doing a transaction of borrow rupees and invest in pound, then in that case he will borrow more amount of rupees and he will invest in pound. This is the transaction in which he is entering upon borrow rupees, investing in pound. So borrow rupees, sell rupees, purchase pound and invest in pound. These are the combination of the transaction, and sell rupees, purchase pound, in that for more amount of the rupees you can get a pound. This is what we understand. Now we understand that say for sell rupees and purchase pound, that is a transaction, so higher amount of the rupees. Now in forward what will you do? In forward you will go for the transaction for forward transaction will be sell of pound and purchase of rupees. That is the forward contract in which you will enter upon. Sell of pound and purchase of rupees. So for every 1 pound, we understand that so the rate which is applicable over here will be considered. Listen carefully what I am going to speak now. 72.70 is what you have borrowed. So 72.7 plus 2%. So you have to make a repayment of the loan of 74.154. That is product of this two. So this is the repayment of the loan that you have. As against that say you have the maturity amount of deposit of 1.0125. When you convert the maturity amount of the deposit into the repayment of loan currency, if at all you get exactly the amount of the repayment of the loan, then in that case you will be at break-even point. It means that say the break-even rate is this. If at all as a bank I want you to incur a loss, then for every 1 pound what will I do? I will give you the rate which is less than 73.2385. Only in that case, say you will be incurring a loss. This is what we understand. Now what happens actually we understand. Now next, let us think reverse. If at all the transaction is entered upon for borrow pound, sell pound, purchase rupees, and invest in rupees. Suppose you are doing these transactions today. Borrow pound, sell pound, purchase rupees and invest in rupees. Then in that case, what is the forward contract in which you will enter upon? The forward contract in which you will enter upon will be sell of rupees and purchase of pound for repayment of loan. This is what we understand. You have borrowed 1 pound. You have made investment in 70.60 rupees. So we understand and say this is the maturity amount of deposit and this is the repayment of the loan. This is what we understand. When you will convert rupees into, that is rupees into pound, over here we understand and say 70.60 plus 2 percentage, 72.012. When you convert this into pound and you get exactly the same as repayment of the loan, then in that case you will be at no profit, no loss. So what bank should do? Bank should ask for higher amount of the rupees from you. So the break-even rate is 72.012 divided by 1.0125. So the break-even rate is 71.1229 or 1230. If at all the bank is asking from you this amount of the rupees for 1 pound, then in that case you will be at a break-even point. So the bank should ask for an amount which is greater than 71.1230. Then in that case you will be having a loss. So this rate should be, that is, so the sell rupees and purchase pound. So this rate should be higher than 70.6 plus 2 percentage, 72.012 divided by 1.0125. Over here friends, the rate is 72.6. I'm sorry. So this will become 72.6 into 1.02. So it is 74.052 divided by 1.0125. That comes to 73.1378. Okay, so this rate should be greater than 73.1378. In that case, so there will not be any profit, there will not be any arbitrage. So how bank should give the forward exchange rate? Bank should give forward exchange rate so that both the conditions are satisfied. We can say that the left hand side rate should be lower than this and the right hand side rate should be higher than this. So simply we understand that say we may have the forward exchange rate as 73/74. Then in that case there is no arbitrage. We may have the forward exchange rate as 73.10/73.2, 73.20. Even in that case there is no arbitrage. Like that, so there will be multiple rates for which there is no arbitrage. In this question, the information is given as 73.80 slash 73.40. This is what we understand is the forward exchange rate. Now you can see that 73.80 is lower than this, so arbitrage is not there. I'm sorry, 72.80. The given forward exchange rate in the question. 72.80 is lower than this, so there is no arbitrage. And 73.40 is higher than this, so again there is no arbitrage. That is the reason the arbitrage is not there in this question. Write down method number 2, and in that you write down this exchange rate first of all. Please write down further. After making above calculations, we have to make a comparison as under. In that write down borrow rupees, sell rupees, purchase pound, invest in pound, forward contract, sell pound, purchase rupees. In borrow rupees it is 72.70. Then you sell that amount of rupees and you get a pound and you invest in a pound. So this is the liability that you will have. $74.154, and this is the asset that you will have. 1.0125. And based on that, so the cross currency rate would be found. $73.2385 rupees per pound. This is the cross currency rate. Now over here you have to be slightly careful. For every 1 pound you are going to get rupees, and we understand that you should be getting lower amount of the rupees. So for this transaction you should be having lower than 73.2385 rupees per pound. This is what we understand. Next, borrow pound, sell pound, purchase rupees, invest in rupees. For every 1 pound that you borrow, you will have 72.60 rupees. So for borrowing of the pound, you will have the repayment 1.0125 pound, and for investment in rupees you will have the maturity as 74.052. So the break-even rate is 73.1377 rupees per pound. That is the break-even rate. Okay. Now forward contract is sell of rupees and purchase of pound. So we understand that if at all for this amount of the rupees you can, for this amount of rupees you get a pound, then in that case you will be at break even. So the bank should give the forward exchange rate which is greater than 73.1377 rupees per pound. This is the way we understand. So now the exchange rate should be greater than 73.1377 and over here lower than 73.2835. Rupees per pound. This is the way you find the range. So now you have to make a comparison like 72.80 slash 73.40 rupees per pound. As 72.80 is less than 73.2385 and 73.40 is more than 73.1377. Rupees per pound, so no arbitrage. This is the way we have to write the conclusion.